Welcome back to the deep dive. Our whole mission here is to take this just massive, overwhelming flow of global news, the earnings reports, the technical charts, all the geopolitical alerts, and really just distill it.
Right.
We want to get to the essential, actionable insights that you actually need to be, truly well-informed.
And today is a perfect example of why that's so necessary.
It really is. Today, we're diving deep into one of the most, I think, volatile and perplexing market days we've seen in a while. Wednesday, January 14th, 2026.
It was a day of just profound paradox, wasn't it?
Completely.
On the surface, you had several huge financial institutions poked in what looked like surprisingly strong quarters. Some were even record-breaking.
Oh, yeah.
And yet the market saw a clear, unmistakable retreat. I mean, across all the major indices.
So this wasn't about the core economy failing.
No, not at all. This wasn't a failure of economic fundamentals. It was a direct response to policy decisions, to global friction, and just the sheer pace of technological disruption all colliding head-on.
Absolutely. And that tension, that's what we call the theta fuse moment, right?
Exactly.
It's that volatility that gets sparked when these non-economic factors, so government policy, regulation, geopolitical risk, they suddenly just crash into the future prospects of these, trillion-dollar tech bets.
That's the perfect way to put it.
So our mission today is to really unpack why U.S. stocks, the Dow, the S&P 500, and critically, the tech-heavy NASDAQs, why they all resumed their slide, even when some of the underlying economic data looked pretty solid.
Precisely. We're going to be charting the burn of that fuse. We'll start with the broad market retreat and, who exactly was leading the decline.
Okay.
Then we're going to dive into those twin pillars of policy risks that are shaking global stability right now. The Iran flashpoint and the Supreme Court's looming tariff decision.
Right. And the bank earnings paradox. We have to hit that.
We have to. Why good profit news led to plunging stock prices. And then finally, we'll track their incredible $4 trillion AI race between Alphabet and Nvidia and weigh some, wildly divergent signals from commodities and the transportation sector.
Signals that suggest a deeply confusing economic outlook.
That's putting it mildly.
All right, that is a heavy agenda. Let's start where the damage was most visible. The market close on Wednesday, January 14th.
U.S. stocks definitely retreated, and what's really telling is which sectors felt the pain first and hardest. Investors were clearly weighing, the bank earnings, which were, let's say, mixed on profit, but really dark on the policy risk side.
And that was coupled with fresh economic data and, as you mentioned, those key geopolitical alerts. Iran, China. It was all happening at once.
It was. And the index movements, they were just clear indicators of where investor anxiety was focused, and that was squarely on growth and technology.
The tech-heavy NASDAQ composite, it just led the whole decline. It sank a substantial 1.6% by the close.
Which is a significant daily move for the composite.
Oh, absolutely. The S&P 500 was 1% lower, and even the industrial-focused Dow Jones sank 0.6%, ending the day down about 155 points.
And like you said before, it wasn't a slow drift down either.
No, it was immediate, right at the bell.
That initial slide right at the market open, that gave the clearest signal of the panic. Within minutes, the NASDAQ was down 0.8%, the S&P 0.6%, and the Dow 0.2%.
And the triggers for that opening slide were so explicitly non-economic.
Completely. It was a sharp pullback in financial stocks because of those regulatory fears we'll get into, combined with this sudden, intense focus on potential U.S. military action in Iran.
And then you layer on top of that the uncertainty hanging over the Supreme Court's tariff ruling.
It just hammers home that theta fuse concept you brought up. Market risk right now is being driven by political uncertainty, not, by quarterly GDP numbers.
And when you look deeper into that tech sector, the drag was just overwhelming. We're talking about mega caps that usually show incredible resilience.
They did not show resilience on Wednesday, not at all. Tech-focused mega caps were hit right across the board.
Like Broadcom.
Broadcom, AVGO, a massive chip and infrastructure player, saw its shares dip approximately 5%.
And for a company of that size, a 5% drop isn't just a bad day, it's just a fundamental reevaluation of its near-term growth.
That's right. And Broadcom was just one example. You also saw notable losses hitting Tesla, the EV leader, and of course the company that basically defines the current AI boom, Nvidia and VBA.
So why were these specific high-growth stocks leading the decline? What's the common thread?
It really boils down to their sensitivity to friction. I mean, these companies operate on these razor-thin margins of expected, just massive future growth.
They're priced for perfection.
Absolutely priced for perfection. So any whiff of a regulatory headache or some geopolitical disruption that might, say, delay a product launch, halt sales into a major market, or just increase supply chain costs, it all becomes amplified.
So investors are just selling first and asking questions later.
They have to. They fear that near-term execution risk, particularly when it comes to China and the stability of the supply chain.
It really seems like the entire high-growth story is, for now, hostage to the policy environment.
It is.
So we have to look beyond just the stock tickers here and focus on those external forces that drove that opening action. Let's shift our focus right now to those geopolitical sparks, because they seem to be the primary igniters of this theta fuse.
The policy overhang was heavy, and it came from 3 separate global flashpoints, which really just demonstrates how interconnected market risk has become.
And the most immediate, maybe the most visceral flashpoint came from the Middle East. These heightened worries about potential U.S. military action against Iran. This wasn't just, background noise.
No, not at all. This came right after President Trump ramped up military threats. And that was in response to the deadly crackdown on the public protests that have been roiling Iran for a while now.
So the market fears direct American intervention. Why is that the ultimate black swan event?
Because it introduces unquantifiable political and military risk into one of the world's most critical energy-producing regions. You just can't model that kind of event.
And the market responded immediately, in the most predictable place possible: oil prices.
Of course. Oil futures climbed significantly, hitting a 2-month high. Brent crude, BZF, that's the global benchmark, it jumped above $66 a barrel.
And what fueled this specific rally wasn't just the rhetoric, it was tangible actions on the ground.
That's right. The rally was directly fueled by reports that some U.S. personnel were advised to leave the Al Udeid Air Base in Qatar.
And that facility is critical, right?
It's incredibly critical, and Iran has targeted it before in retaliatory strikes. So the fact that the U.S. is actively pulling some personnel out of a strategic forward position, it suggests the military calculus is shifting.
From deterrence to preparation.
Exactly. And that is a profound shift in risk assessment for any energy trader watching this.
So for you listening, just to put the energy stakes in perspective, what would American intervention potentially disrupt? What's at risk here?
The stakes are enormous. Traders are focused on the direct threat to Iran's crude output, which currently runs at roughly 3.3 million barrels a day. And that's not including a significant amount of gassy liquids. So if even a fraction of that supply is threatened or just removed from the global market because of a conflict,
the economic shockwaves would be immediate and severe.
absolutely, pushing global inflation higher, threatening the whole fragile growth recovery we've been seeing.
And then we had Energy Secretary Chris Wright wading into the discussion. He noted that the U.S. would happily be a commercial partner for Iranian crude if the current regime fell. That seems like a very direct thing to say publicly.
It's the kind of high-level statement that's usually reserved for, diplomatic back channels, not for public consumption.
It absolutely elevates the political temperature.
It does. When a sitting cabinet member openly discusses the potential for regime change in a major oil-producing nation, it tells the market the current administration is actively entertaining extreme military and political solutions.
So it's an inflammatory statement that just fuels the market's fear premium on oil.
It's the definition of policy risk overriding fundamental supply and demand calculations.
Okay, so shifting gears but staying on policy. Domestically, here in the U.S., we had another massive source of uncertainty: the Supreme Court and the tariff challenge.
This is a slower burn, but it's an incredibly costly one. The U.S. Supreme Court, again, declined to rule on Wednesday.
So they kicked the can down the road.
They did.
Okay.
On the legal challenges to President Trump's sweeping tariffs, this marks yet another week of just paralyzing uncertainty for businesses.
So why does this ruling, or I guess the lack of a ruling, have such huge implications for corporate America?
Well, think about the supply chain managers and CFOs of every single company that imports goods from China, Europe, or other targeted regions.
Right.
They've been forced to pay massive import duties. We're talking billions of dollars collectively since the tariffs first went into effect.
So if the Supreme Court rules against the president,
those companies stand to get massive, potentially game-changing refunds on duties they've already paid. But conversely, if the court upholds the tariffs, that money is gone forever, and the cost of imports just remains permanently high.
and so these companies are just in limbo. They can't confidently project cash flow or investment based on a ruling that could come at any minute or be delayed indefinitely, like we saw.
Exactly. This regulatory paralysis, it affects investment decisions, it affects hiring, supply chain restructuring. It touches everything.
And when the head of state weighs in, it only amplifies the tension.
It does. President Trump himself framed the case as a national security flashpoint, saying that if the court rules against him, we're screwed.
That kind of language, that introduces a level of political antagonism toward the judiciary that financial markets see as really corrosive to stability.
It's an absolute multiplier of that theta fuse volatility we're talking about.
And then finally, the third piece of this policy puzzle. The long-running tech and trade competition with China gave us another clear signal, this time in the cybersecurity sector.
Yes, the digital decoupling continues, and the market felt it directly. Reports surfaced that Chinese authorities have reportedly told their domestic companies to immediately stop using cybersecurity software from about a dozen U.S. and Israeli firms.
And the reason given was?
You guessed it, national security concerns.
So this isn't just about general trade tariffs. This is a direct, targeted policy aimed at carving out market share for China's own domestic providers.
It is pure technological protectionism, just cloaked in security jargon. And the market impact was immediate and precise.
You saw it in the pre-market.
It did. U.S. cybersecurity firms Palo Alto Networks, that's PAN&W, and Fortinet, FTNT, both edged lower by 3% in pre-market trading.
And these are companies that rely heavily on big international contracts.
They do. So being suddenly shut out of the vast Chinese market because of a government directive translates directly into a loss of future revenue potential. It's a textbook example of how a seemingly narrow government policy can immediately depress the valuations of public companies caught in that crossfire.
So just to recap the policy picture, we have the fear of military conflict in Iran. We have massive domestic regulatory uncertainty with the tariffs and a direct trade hit from the China cyber ban. This policy environment then set the stage for one of the day's biggest head-scratchers, the bank earnings paradox.
This section absolutely embodies the theta fuse concept.
It really does. We had Bank of America, BAC, and Wells Fargo, WFC, both report quarterly results. And while one beat expectations strongly and the other had a sort of predictable miss due to restructuring, their stocks, along with Citigroup and JP Morgan, just plunged.
They did.
So why did good news equal bad stock performance?
It was a sector-wide hemorrhage, and it was driven by policy fear. Plain and simple.
The numbers were incredible. BAC and Wells Fargo down more than 5% each.
Citigroup dropped more than 4%. JP Morgan, which reported the day before, it declined another 1.4%. The market was basically treating the entire financial sector as toxic.
Not because of what they earned last quarter,
but because of what policymakers might do next quarter. That was the fear.
Let's break down the Bank of America story first, because it's the clearest paradox of the day. BAC actually beat consensus expectations on their Q4 earnings.
They did. Their results were driven by two main things: volatile markets and better than expected net interest income, or NII.
Okay, so for everyone listening, that NII component is key. Can you break that down?
Sure. Net interest income is just the difference between the money a bank earns on its assets like loans and securities and the money it pays out on its liabilities like customer deposits.
And in a high-rate environment, that's the core engine of their profitability.
It is the absolute core engine, and BAC's NII outperformed expectations, which signals that their core lending and deposit business remains really robust.
And on top of that, their specific trading win was phenomenal. Revenue from equity trading rose a staggering 23% to over $2 billion.
Beating analyst estimates by a wide margin. That kind of volatility-driven revenue is usually rewarded by the market.
And what's even more ironic is the source of that volatility.
Yes. BAC's own internal reporting suggested this surge in client trading activity was explicitly linked back to that geopolitical friction we just discussed.
Specifically, the uncertainty caused by President Trump's tariffs last year.
Exactly. So the very same policy risk that terrifies the supply chain actually creates fantastic arbitrage opportunities and client churn for the trading desks.
So the market rewarded Bank of America with massive trading profits.
but punished the stock for the exact same policy risk that created those profits. That is the paradox in a nutshell.
Incredible. Now let's look quickly at Wells Fargo WFC. They did post results that fell short of estimates, but even here, the market reaction feels way out of proportion.
It does. Wells Fargo's profit was impacted, but it was primarily by what you'd call strategic one-time costs.
The severance costs.
Right. They spent $612 million on severance as part of a major long-term cost-cutting plan. This resulted in them cutting about 5,600 employees.
So this is the bank choosing to take a short-term financial hit for future efficiency. Analysts usually look past these kinds of planned charges.
They do, and WFC's NII of $12.3 billion was only slightly lower than the $12.4 billion analysts had projected. It was a minor miss.
So again, if one major bank beats expectations and the other has a minor miss because of a planned reduction in force, why the 4 to 5% sector-wide bloodbath?
This is where we have to come back to the policy overhang explanation, because that is the defining driver here. Market strategists were unanimous in pointing out that this decline was not a fundamental rebuke of the bank's operational results.
Investment banking weakness was expected. NII was mostly fine.
The fear is purely regulatory and political.
We saw that from HSBC's head of U.S. financials research, Saul Martinez. He was very clear, attributing J.P. Morgan's underperformance and the whole slide to this policy overhang.
Yes, and crucially, he also mentioned investors having too high expectations for continued deregulation.
Martinez's analysis is so vital for understanding this theta fuse. I mean, for years, large banks have benefited immensely from a regulatory environment that was steadily moving towards deregulation.
It was a one-way street. Less capital was required, complexity was reduced, and policy was seen as uniformly beneficial to maximizing their profitability. The market had priced in the continuation of this one-way dynamic.
But the fear now is a pivot, a full reversal. What specific policy news was fueling this sudden anxiety?
It was amplified by some recent news flow concerning a potential rate cap. It was being discussed, maybe just informally on social media and in political commentary.
But the idea of a rate cap, a mandated ceiling on the interest rates banks can charge, especially on things like consumer loans or credit cards.
That would severely restrict the most profitable parts of their business. It wouldn't matter how efficient or profitable their trading desks are.
So the market isn't reacting to BAC's $2 billion in trading revenue today.
No.
It's reacting to the perceived risk of future legislation that could cap their profits tomorrow.
Precisely. They are pricing in the risk of a regulatory reversal. And this negative sentiment, it was a sector-wide drag. You saw Goldman Sachs, Morgan Stanley, BlackRock all trading lower ahead of their own earnings reports.
Which just confirms that investors are viewing the entire financial services industry as being under a political cloud. And that's overriding any individual earnings beat.
That's right.
So if the banks were struggling with the friction of the theta fuse policy overriding profit, the tech sector was also split right down the middle.
It was.
One company achieving just staggering dominance and another running headlong into that exact same geopolitical friction.
Yeah.
This is the front line of the $4 trillion AI race.
The contrast between Alphabet and Nvidia on Wednesday was just striking, and it provides a really clear picture of who is currently navigating the political landscape successfully and who is suffering the consequences of this tech decoupling.
Let's start with Alphabet, GOGL. The numbers are just astronomical. They've had an absolutely scorching start to 2026.
They have. Shares of the search giant are up 7.7% just this year. That makes it the best performing member of the Magnificent Seven by a country mile.
And the headline number, its market capitalization settled above $4 trillion for the first time on Monday.
$4 trillion. It's a milestone that just confirms their strategic success. And the engine driving this massive surge isn't just organic growth. It's a huge strategic power move.
The new multi-year collaboration between Google and Apple.
That's the one.
So tell us why this Google-Apple deal is such a game changer for the entire AI landscape.
It's all about ecosystem control. Google's sophisticated Gemini models and its cloud technology are now set to power the next generation of Apple's AI.
Including the new version of Siri that everyone's waiting for.
Including the new Siri. So this means that pretty much every smartphone user on the planet, whether they're on an iPhone or an Android, will be interacting with a Google-powered AI model.
That is an immense strategic victory. And it carries a huge price tag for the losers in this race.
It's a huge loss, as analysts called it, for OpenAI, which of course is backed by Microsoft.
Right. They were hoping for that deal.
They were actively hoping to announce a similar deal with Apple. So by securing this collaboration, Google effectively cements its dominance, not just by developing better AI, but by licensing it to the most critical hardware gatekeepers in the world.
And crucially, this deal changes the competitive threat to Google's own core search business.
Exactly. For years, the big fear for Google was that a competing AI service like OpenAI would disrupt their lucrative search monopoly, by letting users skip traditional search results and go straight to an AI answer.
But by partnering with Apple.
They ensure that they control the underlying AI technology that's embedded in the operating system. It lets Google disrupt its own core search business, but on its own terms.
Rather than ceding that fundamental shift and all the future revenue to a competitor.
That's it. And the confidence in Alphabet is so high now that one veteran trader suggested Google could end the year with the highest market cap, even surpassing Nvidia's current $4.52 trillion cap.
Wow, that is a truly aggressive forecast. But it's based on the power of this Apple deal.
It reflects the market's realization that right now, software and ecosystem integration are outweighing hardware dominance, especially when that hardware is facing geopolitical friction.
And that brings us perfectly to Nvidia, the current hardware king, which is running straight into those geopolitical headwinds we mentioned earlier.
Yeah. Nvidia shares lost ground on Wednesday despite what should have been a positive signal.
Right. The U.S. formally approved the export of its high-powered H200 chips to China, with conditions, but it was approved.
It was approved. The U.S. government signaled go, but Beijing seems to have signaled stop.
And that's the core of the problem.
It is. Reports emerged that Chinese customs authorities are just not allowing the entrance of these H200 AI chips into the country. This creates enormous strategic complications for Nvidia. The U.S. says they can sell it. China says they can't import it.
So how significant is the Chinese market for Nvidia? Why is this customs block happening right now?
Well, China was, at one point, Nvidia's second most important market globally. Their CEO, Jensen Huang, once called the potential for AI hardware sales there a $50 billion opportunity.
A $50 billion opportunity.
And these geopolitical tensions have been eroding that market for years. If you remember, the U.S. initially restricted sales of even lower-end AI chips back in 2025.
Then there was that brief relaxation of the rules.
Yes. After some intense lobbying, the Trump administration relaxed the restriction for the more powerful H200 chip, reportedly in exchange for a cut of the sales as a sort of concession.
But now Beijing's new restrictions are prioritizing their own domestic chip development.
They're taking a calculated national policy risk.
And that calculated risk being that even though their own domestic processors lag significantly behind the H200 for training these large-scale AI models,
Beijing is willing to sacrifice short-term technological efficiency for long-term domestic self-reliance.
So this isn't about market efficiency. It's pure national policy over corporate profit.
Absolutely. The theta fuse is lit. A $1 trillion technological potential is being short-circuited by direct government policy, regardless of the best interests of the U.S. corporation or even the global AI race.
And Nvidia is just stuck in the middle.
Stuck between two massive governments, and its growth prospects suffer immediately.
All right, so moving away from that policy-driven stock market turbulence, let's look at the purely economic signals we got on Wednesday. We had some fresh readings on wholesale and consumer inflation that give crucial context for what the Fed will likely do next.
And the data really just confirmed what most people were expecting. Prices are remaining stickier than the Fed would like.
So no rate cuts coming soon.
It reinforces the notion that the Fed will hold rates steady in January and is very unlikely to cut in the near term. This data will be critical for them as they chart their course for 2026.
We got a delayed release of the Producer Price Index, the PPI, for November. That was delayed because of the government shutdown late last year.
Right.
So for listeners, the PPI measures wholesale inflation, the prices domestic producers get for their output. It's basically inflation before it hits you, the consumer.
And that wholesale PPI came in hotter than expected. 3.0% year over year, which was more than the 2.7% economists were looking for.
That's a significant beat. It indicates input costs are still rising for businesses.
They are.
So if we break down the details of that jump, where was the immediate pressure coming from?
On a month-over-month basis, the key driver was a big 0.9% increase in prices for final goods, so finished products ready for sale.
And that was the largest monthly jump since February 2024.
It was, and overwhelmingly, this was fueled by a huge spike in gasoline prices. They soared 10.5% during the month.
Okay, so if we look at the headline PPI, it's mostly energy, But the Fed often focuses on core inflation to see if price increases are structural or just coming from volatile inputs. How did the core numbers look?
Well, if you strip out those volatile components, food and energy, the prices of goods only rose 0.2%.
Okay, that sounds better.
It does, however, the metric the Fed really keys in on is the core PPI, excluding food, energy, and trade services. This is designed to gauge the underlying cost pressures, and that core measure still rose 3.5% year over year.
A 3.5% core PPI climb is substantial. Why does that specific number matter so much?
Well, that 3.5% figure was higher than the 2.9% that was projected, and it represents the biggest climb in the core PPI since March of 2025.
So over a year.
Right. And it matters because it signals that underlying service costs, labor costs, and other input pressures are persisting outside of just energy price fluctuations. The stickiness of that core inflation number is what prevents the Fed from even speculating on immediate rate cuts.
It essentially locks their hands.
It does. They have to maintain high rates until this core figure shows a clear, sustained deceleration toward their 2% target.
So while inflation was sticky, the consumer side did offer a bit of a ray of hope regarding resilience.
Yeah.
We got a delayed release on retail sales from the U.S. Census Bureau.
Yes. The data on retail and food services sales in November showed total sales of $735.9 billion.
Which was a positive uptick.
It was a 0.6% increase from the prior month, which was slightly higher than the 0.5% that analysts were projecting.
And what drove that gain? Was it people buying discretionary items or just necessities?
The most significant element driving that gain was a notable resurgence in auto sales during November, and that is a crucial signal.
Why is that?
Because it shows that despite the lingering inflation and high borrowing costs, consumers are still willing and able to spend on large, discretionary, high-ticket items like new cars. It suggests a continued underlying resilience in consumer demand.
So the consumer has not completely capitulated to this high-rate environment.
Not completely. It provides a positive signal for broader economic activity, even as credit costs stay high.
This is where our deep dive gets truly fascinating, because the signals we've just covered are pointing in completely opposite directions.
Diametrically opposite directions.
We're seeing record highs in indicators that suggest fundamental physical growth, fighting against record highs in assets driven by profound global anxiety. It is an investor's nightmare of conflicting information.
It's a dizzying mix, and we have to start with perhaps the most optimistic, forward-looking signal of the day. The validation of the ancient Dow theory coming from transportation stocks.
Now, for our listeners who might not track this, the Dow theory is a century-old technical analysis method. Why is it still relevant now, when we have supercomputers crunching all this data?
It's relevant because it focuses on physical commerce, not just job creation or sentiment surveys. Strategists are urging investors to look past the backward-looking jobs reports.
Arguing that labor data is less reliable now.
Exactly, because of massive recent productivity gains. The actual movement of goods transportation is a pure measure of real commerce happening on the ground.
And the transportation average is just screaming confidence right now.
It is. The Dow Jones Transportation Average, the DJT, which includes airlines, railroads, trucking companies, it hit a record high of 18,184.62 on January 9th. And that bullish signal continued to resonate this week.
So this breakout, along with strength in cyclicals like small caps, it suggests the market anticipates an improvement in broader physical economic activity.
Yes, activity that extends well beyond just the big tech players sitting on the NASDAQ.
So under the formal rules of the Dow theory, how does this record high in transportation confirm a bullish outlook?
Well, under the original theory, which was codified by Charles Dow himself, a bull market is considered real and sustainable only when both the industrials, the producers of goods, tracked by the DJIA, and the transportation sector, the movers of those goods, hit new highs concurrently.
So the DJT hitting that record suggests that demand for shipping, freight, logistics, it's all surging.
It indicates robust underlying physical economic strength. Goods are moving, commerce is flowing, businesses are expanding their physical footprint. That is a foundational sign of growth.
Okay, so hold that signal in your mind. Full speed ahead. Now we have to contrast it with the blistering metals rally, which suggests the exact opposite: profound anxiety and a flight to safety.
This contrast is the clearest manifestation of the market's conflicted psychology. We saw an absolutely dramatic start to the year in commodities. Gold, silver, copper, and tin all hit record highs on Wednesday.
Silver in particular.
Silver jumped as much as 5.3%, topping $90 an ounce for the first time in history. And gold notched yet another all-time peak.
$90 for silver is just astonishing. What is driving this unprecedented run in precious metals?
There are two major interwoven factors. The first is market expectation. These persistent bets on further U.S. rate cuts by the Fed to bolster growth, eventually.
Right, because lower rates make non-yielding assets like gold and silver more attractive.
Exactly. It reduces the opportunity cost. But the second factor seems far more fundamental, almost existential. The increasingly tense geopolitical backdrop coupled with a persistently weak dollar. As one influential Chinese market commentator noted, when gold moves first, it usually signals declining trust in fiat currencies.
So this rally is a global flight away from paper assets backed by governments that are perceived as unstable and into tangible value.
That's it.
Let's put this in some historical context. Gold rose 65% last year. Silver jumped nearly 150%. Those are staggering figures.
They are their best annual performances since 1979, and you need to remember what 1979 represented.
An era of extremely high inflation.
A collapse in global trust in the dollar after the end of the gold standard, an intense geopolitical turmoil, the Soviet invasion of Afghanistan, the Iranian Revolution, the second major oil shock.
So the market is viewing today's political friction, Iran, China, domestic policy chaos, through that same lens of extreme global uncertainty.
That's right. People are hedging against systemic risk.
So we have the Dow theory saying the real economy is strong, and gold and silver saying the global political order is unstable and fiat currency is risky. Now, let's look at a new market that was reacting strongly to regulatory clarity.
And that's the crypto market jump. Cryptocurrencies surged on Wednesday after the U.S. Senate unveiled draft legislation designed to create rules for the crypto market.
So for an industry that has operated under the shadow of regulatory uncertainty for years, just the drafting of a bill is seen as a huge bullish step.
Massive. It's a step toward legitimacy and institutional acceptance, even if the bill is just a draft.
And the gains reflected that relief. Bitcoin, BTC-USD, advanced 3.7%, breaking above $97,000 for the first time since November.
Ethereum, ETH-USD, climbed more than 5%, and the stock market beneficiaries followed right along.
MicroStrategy, the largest corporate holder of Bitcoin, soared 7%.
Coinbase, the major U.S. exchange, put on 3%, and Riot Platforms, the mining giant, advanced 4%. The perception of future stability, even if it involves some regulation, acts as a powerful bullish catalyst in these new markets.
Okay, so now let's swing back from the new markets to the deep distress affecting the average consumer and the old economy, retail and housing.
And the contrast here is jarring. While Google is celebrating a $4 trillion valuation and the Dow transports are hitting records, Main Street is really struggling.
The retail environment is absolutely brutal, and that's exemplified by the collapse of Saks Global.
A huge name in luxury retail. They filed for Chapter 11 bankruptcy late Tuesday.
What was the core reason for its failure?
They struggled primarily with the debt load they took on from their $2.7 billion acquisition of Neiman Marcus in late 2024.
So a classic case of a highly leveraged buyout.
Meeting a stressed consumer environment. The filing was triggered when they missed a crucial $100 million interest payment. And the internal turmoil was highlighted by the fact that the CEO, Richard Baker, stepped down after just 2 weeks in the role.
2 weeks. That's a sure sign of existential chaos inside the company.
It is, and Saks isn't an isolated incident. It's a reflection of a much wider trend. The filing reflects a tough operating environment where consumers are deeply worried about rising prices and are aggressively turning to off-price and discount retailers.
You've seen other major names. Joann Fabrics, Party City, Forever 21, Rite Aid. All have fallen into bankruptcy recently.
The high-end leveraged retail model is just unsustainable under these economic conditions.
And finally, the very foundation of the American dream, the housing market, is in a deep freeze.
A profound freeze. 2025 marked the third straight year this critical market was frozen solid. Home sales totaled 4.06 million, which is tied for the lowest level in 3 decades.
Unchanged from 2024 and the lowest figure since 1995.
That 1995 figure is staggering. It really underlines how much the average consumer's reality is diverging from these trillion-dollar AI valuations.
So why the persistent paralysis in housing?
It's driven by the confluence of high mortgage rates and elevated prices. Buyers are sidelined because borrowing costs are prohibitive.
And sellers who locked in low rates years ago are reluctant to move.
Exactly, because they can't afford to finance a new house at current rates. So it creates this state of stasis where transactions simply halt.
It just underscores this two-speed economy we're in. The freight trains are moving and Google is conquering AI, but the average person is struggling to afford the basic asset foundation of wealth.
Hmm.
Which brings us right back to the central tension of the day. We've mapped the burn of the theta fuse, and the resulting landscape is, well, it's a coherent
It
mess.
is a mess, but the driver is clear.
We have the record high in transportation stocks, suggesting real physical economic strength. And this is fighting against the policy fears crushing global financial stocks and the very real distress we see in housing and retail.
The market is currently being driven far more by that external policy risk: Iran, China, tariffs, the threat of banking regulation, and these massive disruptive tech shifts like the Google AI ascendancy.
Than it is by the underlying fundamental economic data.
Exactly. The data showed only muted, sticky inflation and stable, if selective, retail sales.
So the volatility is being ignited by uncertainty, not necessarily by economic failure. The theta fuse is fully lit.
Indeed.
Oh.
And that leads us to the final provocative thought for you to consider as you digest this deep dive.
Okay.
The divergence we've seen on this one single day, the record-setting rally in metals, driven by declining trust in fiat currencies and profound geopolitical uncertainty.
Versus the stock market's retreat.
It suggests investors are hedging their bets in the most dramatic way possible. We have simultaneous record highs in fear assets like gold and silver, and at the same time, record highs in leading physical growth indicators like the Dow Jones Transportation Average.
So which signal wins out?
That's the question. Which signal, the safety trade driven by anxiety and fiat mistrust, or the growth indicator driven by physical commerce, will prove to be the true compass for 2026? Think about which divergence defines your current investment thesis, and we'll see you on the next deep dive.